Welcome back. You're watching Stock Watch with me, Zinati Kuma, and joining me to take your stock-related questions tonight are Ricus Reeders from Hole-in-One Ruimsig and PSG Hole-in-One Ruimsig, and Mutooni from Sanlam Investments. Be sure to send your questions on email at stockwatch@bdtv.co.za or via SMS to 41392 or on X using the hashtag StockWatch. Thanks for your time, gents. Let's start off with you, Ricus. Hole-in-One. The platinum stocks flew today. And I mean, we're talking about Northam up 16%, Amplats up 14%, Amplats 10%. Even Sibanye participated with a more than 7% climb, and African Rainbow Minerals. Just talk to me about this buoyancy that we saw today.
Well, it's on the announcement that America is asking its G7 partners to participate in blocking Russia's palladium sales, and Russia accounts for the majority of palladium production in the world. So that's the news that platinum shares needed today. They've been trending sideways for a very long time now, since about the end of 2023, and they certainly, got a boost. And as I said, you saw the performance just on a bit of good news today.
Wow, incredible.
Or possible.
Yeah, incredible. I mean, Roy, what have you made of this? And I mean, could it last? Could this be where the bottom was found?
This is the excitement around commodity stocks, especially single commodity stocks. The volatility is immense. I mean, I was just checking it up now. Since August, palladium's up 36%, give or take. And you've seen that leverage move. So the thing is, the commodities have sold off for a long time. They've moved sideways. They've fallen. They've been trading at below that $1,000 range. And I guess investors basically had gone to the point where they figured there's not much growth. There's the whole issue about EVs and everything, so they've all ignored them. So any bit of good news, I think, puts a fire under their bellies, and this is what you see. Is this it? I'm not convinced. The truth is the stocks are cheap. The commodity price is low. The issue around Russia is probably real. Is it overdone today? Probably. I guess a little bit of short covering, probably some nervousness around FOMO and all of that. I guess we'll just have to wait and see. The one thing about this industry that you need to know is supply and demand are not entirely balanced. There's been a big expectation that some supply will be taken out to bring them closer to matching. Sibanye is the only one that's announced supply, curtailing some supply, closing down some mines. Nobody else has. I think you need to see a little bit more curtailment or a little bit more optimism on the demand side before you can say this is entirely sustainable.
Well, let's go into Amplats specifically. As a viewer who wants to buy, what size position would be recommended to minimize downside if the cycle continues downward? Well, I mean, just considering the buoyancy that we did see today on the stock, Ricus, do you think that this would still be a good time to buy because they are still cheap, or maybe just wait a little bit for a dip?
Well, it's a 50-50. It can go higher, or it can, just taking a look at a graph this afternoon. No, all of these things are very much at the top of a range of what I've said has basically been almost a year-long sideways movement. So, it's a 50-50 chance. So if you think it's going to go higher, but you're not sure, take off your position that you would want to take, and if the trend upwards continues, then you can move into your full position if you want to hold. Otherwise, if you're wrong, you've limited your downside.
Well, I mean, that's the thing, because the viewer really wants to minimize the downside, but I don't know, can you at this point, Roy?
Look, the thing to think about Amplats is there's a couple of environmental issues. So it's considered probably your best quality platinum stock. It has quite low liquidity because of the big Anglos holding, but we also know that Anglos are probably planning on selling down over a period of time. So you have this commonly referred to overhang risk. The likelihood is that there are more shares that are going to come onto the market. And if the investor is a smallish investor, the likelihood is that there's going to be more shares, there's going to be pressure on the price. So the way he needs to think about it is the shares are coming. Maybe there's a bit of positivity around the industry and an upward bias towards share prices. So you have to balance out. You know what your end game is in terms of numbers of shares. Drip feed yourself into the market as these events come out. We know when the first limit for Anglo-American selling down is going to be. I think they're given 90 days, give or take. Watch and see how many more, take a little bit and take it gradually in that way. I mean, at the end of the day, the investor needs to be quite confident about why they want to be in platinum. And when you're in platinum or PGMs, why Anglos, and then why buy now, and what your ultimate exposure is in a diversified portfolio.
Well, let's apply those questions on Sibanye. The viewer says that Sibanye has not run like other platinum shares. It did participate today, but I guess compared to the other PGM shares, it had the least upside. The viewer says, I already own 677 shares. Average price per share is 58 Rand. If I invest another 10,000, average price per share will drop to 42 Rand. And price per share will be 35 Rand if I buy 20,000 more. Too risky. I am 80 years old and am focused on dividends. It seems that there's a lot of averaging out the viewer wants to do. Is that wise at this point, Ricus?
Look, historic price is just a number. It's got absolutely nothing to do with your outlook going forward. Normally, when a single commodity starts running, and let's assume, for argument's sake, that we are seeing a run in PGMs, your marginal producers is where you want to be. You don't want to be in your safe ones, because they are safe for a reason. They don't have that, the operational gearing that your marginal miner has. Sibanye would normally fall into the category of a marginal producer, but I think the extraneous factors surrounding Sibanye, whether it be their debt or their operational difficulty, etc., is holding them back. You could actually see it in the performance today, even though by mix of what they produce, but they are the biggest producer of palladium of the locally listed stock. So you can see what's holding that back. But certainly you're not holding it for dividends, because these guys don't have money to pay dividends unless they're paid out of debt, which is never a good idea in any event.
I mean, is it ever wise to average out, Roy, in a stock that seems like a falling knife?
Like Ricus says, averaging out is a phenomenon that exists only in your head. The idea here is, when you have an amount of capital, you should invest it in the next best alternative. You should be looking and saying, what can I put this money in that fits my risk reward dynamic and my expectations? It could be something you hold, it could be something new. Averaging down a price is just because that's the way you run it. You bought those shares at whatever price it was. That's your opportunity cost. You own the shares. And in fact, sometimes it could be worthwhile, even in a loss-making situation, to sell the shares and get into something else. It could be. And that's how the investor needs to think about this. Sunk cost is a sunk cost. Forget about the price, you own the share. If you were starting out right now, would you be buying this share? Why? If you wouldn't be buying it, why are you holding it? That's the way to think about it. It's not about averaging in. And if the investor is an income-driven investor, The last place you want to be in is in a marginal producer that's highly levered and probably has some balance sheet issues. That's not where you want to be. If it's yield you're looking for, you probably want to be in a stock that has high margins, strong cash generation, and a track record of paying dividends. That's probably where I would differ with how the investor's thinking.
Well, talking about track record, I mean, Afrimat has a track record of good management, but of course they have had some challenges in this reporting period. They did come out with numbers today. Ricus, just want to start off with you in terms of what you made of those numbers. And actually, as much as we did have pressure on the bottom line, we did see that share price up slightly today, not taking any kind of knock.
Yeah, I think possibly just glancing at the figures during the day, I mean, the biggest problem, apart from the general commodity price environment that we've seen over the past year or so, has been on the iron side of thing, and basically ArcelorMittal not being able to take in as much iron ore as they would normally do because they had to shut down 2 furnaces, which and obviously not being able to export what they can't sell locally because of we all know Transnet and harbours and stuff like that. So in general, operationally, the things that they could control, they did very well. I think the Lafarge cement operation is being turned around. Their aggregates and other minerals, did well operationally. Their costs were well contained, although up. So it's just, again, good management, good running of the business, extraneous factors impacting the bottom line over the past 6 months. Yeah, so and it was a stock pick of mine a few weeks ago, and I said, well, if we do have a commodity run, specifically in iron, it will benefit Afrimat. But even if that doesn't eventuate, just on the aggregate side, they should benefit from continued, hopefully, and possible positive sentiment as far as the local economy is concerned, which obviously, if sentiment leads economic activity, and Afrimat will be a direct benefactor of that.
All right. So looking at the balance sheet, they have a current debt of 4 billion rand and only liquid position of 1.7 billion rand, cash and debtors. Looking at these numbers, one would say they are highly illiquid and in a high financial risk position. The interest expense also increased almost 200%. The significant portion of the borrowing, more than 1 billion, is current liabilities. Profitability is also now being threatened by high costs of shipping and other costs and lower iron ore prices. Dividends slashed by 75%. I'm a holder. Should I be worried, especially looking at these numbers? Is the debt something that should be keeping investors up at night on Afrimat, Roy?
Okay. I think you have to think of this in a framework. So the thing about Afrimat is they're very astute management who have grown the business from being a building materials business to a diversified commodities, a diversified materials business, which is bringing in some very cheap assets on the iron ore side and some very opportunistic purchases. They recently got the Lafarge business, and I think that's probably what kicked up the debt a little bit. And I think what you need to ask yourself is, do you trust management to be as successful as they've been with all the other assets? I would argue probably yes. Okay. In all likelihood as well, now you're going to see a bit more influence of the cyclical nature of the iron ore cycle. That's going to be there. Do you trust management to manage that cyclicality in the context of the building materials industry and the context of SA? I would argue yes as well. So there's always going to be ups and downs. This is a business that is growing by putting assets together and getting them to operate over time. At a single point in time, the debt may seem a little bit excessive, though when I look at the numbers, it doesn't look anywhere near being excessive. Maybe at balance sheet date, they had a little bit excess working capital, or they hadn't settled something, or one of the assets wasn't functioning, so there was no revenue. It could be something like that. But I think over the long time, Andries van Heerden has shown that he's got an eye for detail. He's a strong operator and has a very clear strategic vision for where this business is going to go, and you have to walk the journey with him. This isn't something that happens in 6 months, 1 year. This is a long-term thing. This is a big business that he's building, and I think you should back him.
All right. Well, let's go into retail and clothing retail at that. Is Truworths a buy, and is it undervalued, Ricus?
I've never really followed Truworths, although because for years they were perennial underperformer, although this year or year and a half they've done very well.
Yeah.
I think I'm talking from PSG's side, they don't think it offers value at the moment, and they prefer Mr. Price. In general, I think the clothing retailers have had a very good run over the past 6 months, and there's probably, based again on more positive sentiment on the South African situation in general and consumers specifically, if you take a look at the Consumer Confidence Index. So I think that sector has run a little bit hard, but again, I'm sort of sticking with our
Mr.
company's view, and I would probably prefer Mr. Price.
On your side, Roy?
It's an interesting business. This is one where they've been able to merge credit retailing. So there's the book and then there's the retailer. Like Rico said, they'd lagged for a long time. They've done incredibly well, but that's been the case for Mr. Price and for the Foschini Group as well. I think there's a whole feeling that with interest rates coming down and generally broader, more positive sentiment, the clothing retailers will benefit, particularly from things like Two-Pot as well.
Yes.
So you've seen a lot of money coming into it. I mean, when I look at the multiples, it's probably trading at about a 12 times forward, which is higher than it's traded historically. It means that the market is ascribing a whole lot more growth than it has typically historically. So you have to be confident that that growth is going to come in and more. That I think is the thing. It's a good quality company. I guess it's playing into the consumer space. They've never had a problem running their credit book, so it's relatively solid and has a high dividend yield. But you have to be confident that the growth is going to come through in the coming years to justify that multiple. So is it cheap? Probably not. Is it overvalued? I guess it's in the eye of the beholder. You have to be confident that between Two-Pot, lower interest rates, greater confidence and everything, that the earnings will come through on a consistent basis.
We're talking about cheap. There's Sasol. At 105, should I invest in the stock, Ricus?
No, sorry. It might have some terrific upside in the short term, depending on what happens with oil prices and chemical prices, but I still think it's operationally a business that's got problems, whether it be on the high dependency on chemical prices, the local coal problems they've got. I think if one wants to be in the chemical or the oil business, there are far better companies worldwide than Sasol. But I'm not. But as I've said, one can have terrific little price movements in the interim. But at the end of the day, do I want to hold Sasol in my portfolio? And no.
Well, another question on that. Please ask the panel if Sasol will fall under 100 Rand. I mean, it's at 105 now. But also, as much as it's really, really cheap under 100, does that not mean that there are more problems that investors are seeing if it goes under 100 Rand, Roy?
Look, there's a lot of negativity priced into that share. I think last time I checked, it's trading on a 2 or 3 times PE or 2 or 3 times EV/EBITDA. But just remember, exactly like Ricus said, there's other oil companies globally. So who's your marginal buyer? Most big institutions who wanted to hold an oil company hold Sasol as it is. They've burnt as much as any of the investors. So for it to turn, you have to see a sustainable improvement in its ESG prospects or its operating prospects or the chemical cycle or the oil price or in something in the US there's so many things that need to go right for it to turn around. There's other things to do, to be honest. I mean, you could have had this discussion at 120, at 130. We had the discussion at 30. We had the discussion at 60. It's always the same issues. So the truth is, at the margin, it's very difficult to tell why you want to be in this one. The numbers may seem very appealing, but it's very hard to tell why it should double from here. There's enough bad news priced in for people to say it can't halve, but it's just one of those, this is too much work.
Well, talking about work, but work to the upside, we've seen on gold. We've seen it break through record after record. There is a question here for Goldfield specifically. Is it a good buy at this price? Of course, considering also how much gold has run. Ricus, would you still find an opportunity to go into gold at this point, and particularly Goldfields?
You know, last time I was on this show, I was going through the multitude of factors that affects the gold price, and in the end will affect the share price of Goldfields. And I was chatting with one of our advisors, and he quite correctly said, "Oh, you've got this multitude of factors. What is all pointing in the right direction for a further increase in the gold price?" And in fact, there's quite a number, whether it be political instability, whether it be a slowdown in interest rates, which are all positive factors for gold price, central bank buying, which is also positive. So on the balance of probabilities, there's quite a lot of support for the gold price, and then by default Goldfields. And as I mentioned earlier, if you're positive about the single commodity, then the place to be is your marginal producer, where that benefit falls straight through to the bottom line. You've just got to be aware, as I always say, these things are trading vehicles. You've got to be very aware of limiting your losses, and just take very careful positioning and also notice of what's happening with those prices.
And just quickly on your side, on specifically Goldfields, because also there have been some periods where it has underperformed operationally, Roy.
Look, the problem with there's a big difference between gold stocks and gold bullion. So gold stocks, you're adding on the risks around gold bullion to the risks around management, geology, geography, and all of those things, because you're looking for operational leverage. You think the gold price is rising, but you think you're going to realize extra margin by investing in the stock. That's the biggest risk that you take. So Ricus and I can sit here the whole day and speak about financial repression and geopolitics and everything that supports the gold price. But when you're going into the company, make sure you know the standard things. What's it trading at? What's its multiple relative to history? Where do I think it should be? What are the margins? All-in sustaining costs. Do they generate cash? Are they geared? Those normal things, you have to be confident with them. And then also remember that the gold stocks tend to underperform the gold price over time. They'll never quite close in. So it's a different risk profile from investing in pure bullion. Bullion is where you have store of value, you have inflation hedge, you have all of those things.
All right, gents, I'm being chased out. Your stock picks. Ricus, what are you choosing today?
McDonald's, in contrast to Sasol, where there's problems operationally, McDonald's just got a listerosis scare. The price has dropped about 5% on that. I like companies which are, I think, brilliant companies, and then something unique happens that doesn't affect the overall profitability of the share going forward, the overall operations. It's just that sentiment that's all of a sudden negative. That's the time to pick up something like McDonald's.
All right. What are you picking up today, Roy?
Premier Mills is still my favorite. I think the more I look at it, its positioning in the bread market, the direction that commodity price is going, the wheat commodity prices, the fact that they're in rice right now, and it's a solid management team that's got their eyes open and looking for opportunities to further diversify the business. And the valuation is not that demanding. So yeah, Premier for me today.
All right. Well, thank you so much for your time and for your analysis today, gents. That is all for tonight's Stock Watch. Thanks to my guests, Ricus Reeders from PSG Hole-in-One Ruimsig and Mutooni from Sanlam Investments. Up next at the close. Stay tuned.